Hey, hi friends. I'm sure most of you do invest, right? And I'm sure most of you come across investing in shares. But how do you determine if a company is worth buying or not? Do you just follow your friends, or do you follow some YouTube channel that say, "Whoa, this company shares is going to 10x, this company shares is going to 3x," and so forth? So to help you better do due diligence, I'm going to share with you a quick method that takes less than 10 minutes to evaluate whether a company is worth buying or not, whether is it overvalued or undervalued or rightly priced. Now, there are other more popular valuation method like DCF, which is your discounted cash flow. There are like PE ratios, price to book, price to sales ratio, that compares against its industry peers. But for today's purposes, I'm just going to share with you a very simple method so that at quick glance, you have a quick guide to assess whether this company is worth it or not at a big picture level before you do your deep dive analysis. And also lastly, I would like to give a disclaimer that I'm not a financial advisor. Please do your own due diligence. I'm just here to share with you what I've learned to help better establish more sense of financial awareness, financial planning. That's my sole purpose, is to help you and to share with you what I know. A lot of things I don't know as well, so let's learn this together. So for this purpose, we're going to talk about Amazon, right, using this evaluation method, because Amazon, I believe, is a big company, it's a household name, all of us are familiar with it. So without further ado, let's dive into it. Before proceeding, appreciate your early thumbs up. It will help with the YouTube algorithm, and also do consider subscribing if you like what you see. What we're going to use today is called the multiple EBITDA method. So what is multiple EBITDA? What is EBITDA to begin with? EBITDA is basically earnings before interest, tax, debt, and amortization. It's basically earnings of the company without factoring in those factors. How this method works is, first of all, you're going to determine what is the EBITDA of the company for this year, and you apply a certain assumption of the growth rate of the company, right? At the fifth year, which is at the end of the fifth year, you were going to arrive at a certain figure. And based on this figure, you're going to apply a multiple factor to determine the valuation of the business. For example, if you have a farm that generates 10,000 a year, definitely you can't sell the business for just 10,000, because you know that the farm is going to continue to generate earnings for several years to come, right? So similarly, how they determine the multiple factor is based on the industry consensus. So in this case here, it's 24, but we'll come into that later. So after multiplying by the multiple factor, you're going to derive to a certain value, which is the terminal value at the end of the fifth year. This is the valuation of the business 5 years down the road. But however, because what is worth 10,000 today is not the same 10,000 5 years down the road, therefore you need to apply a certain discount rate and work it backwards to what is the present value of the terminal value, and therefore PV of TV. Now, before we begin, we're going to determine what is the EBITDA of Amazon. To do that, what we can do is we go to this website called Seeking Alpha, right? And under Seeking Alpha, you can go to this Financials tab. You click Amazon, you go to this Financials tab, and you scroll down, right? And you can actually find the EBITDA of this company, of Amazon, in the trailing 12 months. That means past 12 months, their EBITDA is 59 billion, right? So we're going to key that in, which in this case here already keyed in. And of course, if you notice, I reduced 3 digits because to make it easier. So 59 billion, right? But however, what is the growth rate moving forward for Amazon? To do that, again, we can also leverage onto Seeking Alpha. What we do is, from the Financials tab, we click into this Growth tab. Okay, and you can find that there's an EBITDA growth forward. So what is the forward EBITDA? Which is 27.4%. How do people derive this? Is basically what this 27.4 means is that all the analysts, they have a consensus that Amazon's next year's 2022's EBITDA growth will be 27%. So we're going to apply that. Okay, in this case here, already applied 27.4, right? Okay, And then the next thing to do is to determine what is the next 5 years growth in earnings for Amazon year over year. To be conservative, I have tapered down the growth rate from 20 to 15% to be conservative, right? And therefore, at the end of the 5th year in 2026, we can sort of derive that Amazon's EBITDA is 141 billion. Okay, and if you apply by a multiple factor of 24, you will derive at the valuation of 3.5 trillion. Now, how do we determine this EBITDA multiple? Again, we can also leverage onto other analysts' findings. We can find from this website Equidem. Okay, so we know that based on they have a EBITDA multiple across different industry, right? Because Amazon is under technology sector, it has a average, that means the industry average, right? It has a industry average EBITDA multiple of 24.81, right? So basically what this means is that Amazon is worth 24 years of its earnings, okay, to put it simply, and therefore derive it at 3.5 trillion. But however, like I said, what is worth 3.5 trillion in year 2026 is not worth the same in year 2021. You need to apply a certain discount rate. To be conservative, I apply a discount rate of 10%. Okay, and if you work backwards, you compound this 10% by 5 years and you work it backwards, you will derive at this amount of 2.1 trillion. Okay, so basically what is worth 2.1 trillion in 2021 is worth 3.5 trillion in 2026 if you assume an inflation of 10%. Got it? Right? So that's how it is, and we know that assuming that Amazon grow at this rate, this business is worth 2.1 trillion in today's value, right? And if you look at Amazon's valuation, the market cap in today's terms is 1.69 trillion, right? 1.69 trillion compared to 2.18 trillion, and therefore you know that Amazon at one glance is undervalued, in fact around 20% undervalued. So based on this screener, you will then further proceed to analyze the company using other valuation method to look at its margins, its growth, revenue growth, and so on and so forth, to determine if this business is worth it or not to invest. So yeah, there you have it. And of course, lastly, I just want to give some summary on the discount rate, disclaimer on the discount rate. Why apply a discount rate of 10%? It's just to be conservative. How to determine this discount rate, we'll cover this in the future video. Basically, there's this method called the weighted average cost of capital. Okay, and there's a certain formula to calculate it, but for today's video, we're not going to go into that. And I have done some calculation for the WACC of Apple. It's around 8%. So therefore, to be conservative, I apply even a higher percentage, which is 10%, to be on the safe side. Yeah. So yeah, that's how you determine the discount rate. So applying this discount rate back to today's value, 2.1 trillion, that's how it works. So basically, that's it. That's how you evaluate this company using this quick, less than 10 minutes guide to determine a company whether is it undervalued or overvalued. I hope you learned something today, and also you like what you have saw. If you do, please hit the like button. Appreciate your help, and also do help subscribe. Until then, invest safe.